focus more towards one of the most significant decisions many of you will face when it comes to your ConocoPhillips pension plans. And so many of you are probably considering, should I take the lump sum or should I take the pension annuity? And so we'll kind of cover kind of the main plans that we see most retirees within. So Title 1, so these are for Heritage Phillip employees. Title 4 is going to be the Heritage Conoco employees, and the more recent one, which is no longer provided for new employees, is going to be the ConocoPhillips cash balance plan. And so, and these are the more common pension plans that we see retirees with. And for anybody joining after or on or and after 2019, they would receive what's called a company retirement contribution. So they're just going to contribute 6% into your savings plan, which is your 401k. So they're doing away with the defined benefit plans and going more to the standard 401k match. And so here we kind of have an overview of the two title heritage plans. So kind of similar. So their normal retirement age 65. Each of them does have their early retirement differences. So for Phillips, it's age 55, and Conoco is age 50 with 10 years of service. But the thing is, with these plans, when you go and retire, you don't necessarily have to elect to start your pension. So you can actually retire, and you would like to retire at age 55 and age 50, but you can delay the commencement of your benefits to age 60, where for both of these, you would be able to receive 100% of your pension benefit. And so if you were to retire before these ages for the Phillips and Conoco, they have kind of stricter penalties. And so you would actually need to realize your benefits at age 65 in order to recoup that loss. And so we'll kind of want to make sure early retirement is at least for Phillips age 55 and Conoco age 50, but you can delay your commencement to age 60. And for both of these, they kind of have a formula attached to them. So it's going to be, sorry, let's see. All right. So it's going to kind of be the final average earnings. And so this is your highest 3 consecutive years of eligible pay. Then you have your credited service. So this is how long you've worked, the months and years, and earning benefits within the plan. And then your primary Social Security. So this is kind of an offset because your pension was designed to not pay you 2 pensions in your lifetime, right? It's because it knows that you're going to have Social Security. And so it doesn't want to pay both separately. So that's why it has that offset. So you don't want to, and so that's what kind of reduces your pension calculation. But this should give you your annual pension amount, which divided by 12 is going to give you the monthly amount that you would be paid for the remainder of your life. So this calculation is usually your single life annuity. Comparatively to the cash balance account or the cash balance pension plan, this one is more so a monthly creditation. So you're credited with interest credits. So when we look at the 30-year treasury, based off that number, you're credited that amount. So theoretically, higher 30-year treasury rates actually benefits you. And so your pay credits, so this is taking your years of service and your age. And so this, depending on that combination and the points that you've accumulated, it's either 6%, 7%, or 9% that would be multiplied to your monthly pay. And so the longer you work, the higher the income you receive, both increase your credits added to your account. And so since this is credited monthly, when you sign in to see your benefits, whatever that value is right there is exactly the value you'll get when you retire or if you leave and you commence your benefit. And so it's pretty straightforward versus kind of the annuity calculations where you kind of have to factor in some other things to consider in terms of how you calculate your benefits. But the cash balance, pretty simple. They exactly know what you're going to receive, and it's easier for you because you don't have to do there's no guessing work there. And so for the payment options, for all three, it's pretty standard. It's the single life annuity. So you're going to receive monthly payments for your lifetime only. And this is usually the highest benefit pension. So because it's over your lifetime, and so once you die, they're not paying out anymore. Now, if you are married, the default is usually joint and survivor at 50%. So let's assume for a single annuity, you're receiving 2,500. And if you elect to do the joint survivor annuity, it actually gets reduced since you're paying for two life expectancies. It's going to be reduced to 2,000. Well, in your lifetime, you're going to receive that 2,000, but when you pass and say you elect the 50%, your spouse would only get 1,000. And so that's kind of how it works. So comparatively to the single life, the joint is reduced because you're paying for two life expectancies, but they do get a benefit who pass versus the single life where one and done. And then we have the lump sum. So this one is just a single payment. So we want to kind of roll this into a traditional IRA. We don't want to take the lump sum to yourself because that'll be a big tax bill. But the lump sum is kind of tricky in terms of which plan you fall under, because with the cash balance plan, since it's credited monthly and you can kind of see that balance, versus the heritage plan where you actually have to do kind of a net present value calculation. And this is where interest rates and where the current market is kind of affects that lump sum. And so I can show you on the left-hand side, we can see on the far left, we can see the pension lump sum or the lump sum amounts. Then at the bottom, we're going to see interest rates. And so as interest rates rise, your lump sum decreases. But if interest rates decrease, your lump sums go up. And so uh, we can see in recent interest rate trends. So in 2020 and 2021, you probably saw your lump sum, and it's pretty sizable compared to if you were to take a pension. So you're probably leaning more towards the lump sum. But as of recently, interest rates have risen, and so you've probably seen your lump sums actually go down. But we do see in the near future that interest rates will come down, and so you'll probably slowly see your lump sums increase. And so the decision of whether to take the annuity or lump sum does kind of factor into the plan you're specifically in. And so, you know, looking at interest rates is important because it kind of helps determine kind of when you will commence your benefits. So that's why you kind of want to stay on top of those interest rates and kind of see what's kind of the good timing to take a lump sum or maybe a pension. And the pension doesn't really need to factor in these interest rates. So it's really just a lump sum. And so for considerations, you know, we have the lump sum, so you take full control over the investments and how you spend it. Inflation protection, when you take the annuity, there is no cost of living adjustment. Legacy planning, so when you take the lump sum, you can actually leave that for heirs, assuming it's just you, no spouse. And then for the spouse, again, if you take the lump sum, they have asset ownership of that account. And then factors for annuities, so that's kind of guaranteed lifetime income. Simplicity, there is no managing any assets. And longevity, which basically you're not going to outlive your pension, the amount that's coming to you. But with a lump sum, if you have bad spending habits, you potentially might run the risk of running out of money. And so the spouse as well, so joint rights and survivorship. So this one is just going to help provide something for your spouse when you pass. But again, over time, that benefit is eroded by inflation. And also with the annuity, if you take it, you kind of lose some tax efficiency in terms of your withdrawal strategies because you're already forced to pull. But again, it really depends because either option is kind of highly personal, and each option kind of comes with its own trade-offs. And so what's right for you kind of depends on your situation, your health, how comfortable are you managing investments and your goals, and looking at your family and legacy. So it's highly personal decision.
Okay, and that wraps up the main part of our presentation. And again, we thank you so much for your attention and especially your time that you spent with us. We do have couple more minutes left. If you have any remaining questions, just go ahead and type them in the chat box, and we'll do as best to answer as many as we can. And we do, Oscar, we do have a question, and you kind of wrap that up with that last statement. So what would you say if someone did come and say, which one should I choose, lump sum or annuity? How would you answer that question?
Yeah, so again, like some revert back to this slide. So it's really highly dependent because there are, even though there's a mathematical problem that we could solve here in terms of cash flow, there is still the psychology of it. So if you take the lump sum and let's say you try to manage it yourself and then you see the volatility in the market and you're going in and out, well, you're not really being efficient with that retirement lump sum. You're stressing yourself out. Then maybe you would want to lean more towards the pension because it's guaranteed. You can sleep at night knowing that that monthly check is coming in. But if you want kind of, if you believe yourself or kind of you want to outpace kind of inflation, you may take the lump sum, thinking you can probably beat the annuity itself. And again, that's we could solve for kind of that math equation to how much you need to earn to kind of beat that. But more so, it's really just being able to have flexibility in your tax withdrawals. So that's what's key with lump sums because you can determine, right, your retirement withdrawal strategies. And again, legacy planning. A lot of people like to leave this for other heirs other than their spouse. And so depending on where line up in each camp kind of determines where you'll fall under. But again, the psychology matters more than the number.